Hey everyone. Peloton reported fiscal year 2023 third quarter earnings results that sent the stock crashing over 15% after the release. So in this video, I'm going to review and share the big picture highlights from Peloton's earnings results and answer if the market is overreacting to the stock price and overreacting to the earnings, and if this stock price decrease was justified. So let's begin. So overall revenue decreased by 22% to 749 million. Remember, Peloton is trying to recover from overinvestments made during the pandemic when it thought that consumer demand would stay high even when gyms reopened, which didn't end up being the case, and now it's having to bring itself back. The net loss improved to 276 million. That was an improvement from a loss of 757 million in the third quarter last year. So nice improvement. Product revenue fell by 45% to 324 million. These are the actual bikes, the actual treadmills. Subscription revenue, which comes along with the bikes and treadmills that give you access to the virtual and live classes, ranging from $40 to $50 per month, that increased by 15%. That's important because the product gross margin was negative 17.6%, while the subscription gross margin is 67.8%. So the subscription side of the business is highly profitable and very healthy. Peloton's connected fitness subscriptions total increased to 3.1 million. That was up from 2.96 million year over year. The company added 74,000 subscriptions from the previous quarter. Importantly, the new CEO managed to decrease total operating expenses from 920 million to 536 million. And this helped cash flow from operations improve to negative 41 million. That was an improvement from negative 670 million in the same quarter the year before. The company has cash on the balance sheet of 873 million. So based on the adjustments that this new CEO has made over the course of the last year, the company is now, I can say, on sustainable footing, right? It lost only 41 million in cash flow from operations, and it has about 900 million in cash. So that gives it a lot of time to kind of work itself through, reduce costs without having to make any rash decisions and get itself on a positive cash flow footing. So this is really good news. Last year, you see it lost 670 million in cash flow from operations. That was not sustainable, right? It had a little more cash, but it was on pace to run out of its cash very quickly. Also good news, inventories were down to 625 million. At the same time last year, they had 1.1 billion in inventory. Now, you don't want to have all this inventory when consumer demand for your products is falling and crashing. So it's nice that they're working through the inventory, they're turning that inventory into cash, and that's helping put the company on better footing. Management is forecasting fourth quarter revenue to fall by just 6%. So an incremental improvement. Instead of falling by 22% as it did in the third quarter, it's only going to fall by 6% in the fourth quarter. All in all, I thought this quarter was a really good quarter for Peloton. It made very nice steps towards putting itself on more sustainable footing. And, you know, I believe that the stock price crashing over 15% following these results was an overreaction. Maybe the market was expecting too much from Peloton out of this quarter. I thought that they had a really good quarter in the areas they needed to, right? In my opinion, revenue and net loss were not as important as working through the cash from operations and working down the inventory. I thought those areas were more important than revenue, right? I was okay with the company having revenue decline as long as it's making progress in putting the company on more sustainable footing. So Overall, a good quarter, and I think an overreaction from the market on Peloton's earnings results. Okay, that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.